90% of all startups fail. And the biggest killer isn't a bad idea, a weak product, or even strong competition.
Okay.
It's an empty bank account.
True.
The dream dies when the money runs out. Yet, a select few manage to defy the odds. They navigate a treacherous path, convincing complete strangers to give them millions of dollars, sometimes before they've even sold a single thing. This is the story of how startups raise their first $10 million. It's a journey in 3 acts, from a simple idea to a high-stakes gamble for the future. And it all starts with a stage that has almost nothing to do with business metrics and everything to do with the story.
This is the pre-seed round. Forget about revenue charts and profit margins.
Just forget about it.
At this point, the company might just be a PowerPoint presentation, a few lines of code, and a wild idea in the founders' minds. The amount of money being raised is relatively small in the venture world, anywhere from $50,000 to $500,000, just enough to turn an idea into something real.
It is real.
So what could possibly convince someone to write a check for that? The answer is 2 things.
To what?
The team and the vision. At this stage, investors aren't buying a company. They are betting on the jockey, not the horse. They scrutinize the founding team with incredible intensity. Is there a technical founder who can actually build the thing?
I don't know, maybe.
Is there a business-minded founder who can sell the dream?
I guess there is.
Have they worked together before? Do they have a unique insight into a problem because of their personal experience? This is where the founder story becomes your most valuable asset. The investor is asking themselves, why are you the only people in the world who can solve this problem?
Tell you the truth, I don't really know.
A team of former aerospace engineers proposing a new satellite company is compelling. A team of doctors building a healthcare app is credible. A team of obsessive gamers building a new gaming platform carries weight. The second piece is the vision. The idea can't be small.
No, it can't.
It has to be aimed at a massive market. Investors aren't interested in funding a company that might one day open a few nice cafes. They are looking for ideas that, if they work, could change an entire industry. The story you tell must paint a picture of a future where your company is not just successful, but inevitable. But even with a great team and a huge vision, a critical problem remains. If you have no product and no revenue, how on earth do you decide what your company is worth? Arguing about valuation at this stage can kill a deal before it even starts. The solution is a clever financial invention that completely changed the game for early-stage startups.
When you get that first check, it's usually not in exchange for a specific percentage of your company. That's because, as we said, valuing a company with 0 revenue is pure guesswork. Instead, most pre-seed and seed deals are done using something called a SAFE, which stands for a Simple Agreement for Future Equity. Think of it like this. An investor gives you money today. In return, you give them a special coupon. This coupon promises them that whenever you do raise a real round of funding in the future, one where you set an official price per share, they can cash in their coupon and convert their initial investment into company stock. But here's the clever part. To reward them for taking a risk on you so early, their coupon comes with a perk.
And what is that exactly?
It usually includes a valuation cap or a discount. A discount is simple. If future investors buy shares for $1 each, the early safe investor might get to buy them for 80 cents, a 20% discount. A valuation cap is even more powerful. Let's say an investor gives you $100,000 on a safe with a $10 million valuation cap. You then go on to build the company, and 2 years later, you're so successful that new investors value your company at a whopping $50 million. If your early investor had to convert at that new high valuation, their $100,000 wouldn't get them much of the company.
Nope, I don't think so.
But the valuation cap protects them. It says that for the purpose of their conversion, the company's valuation is capped at $10 million. They get to convert their money as if the company was worth much less, meaning they get a much larger percentage, a huge reward for their early belief. This instrument, the SAFE, allows founders and investors to kick the can of valuation down the road, close the deal quickly, and get back to what actually matters. Because once that money's in the bank, the clock starts ticking. The goal isn't profit. It's to prove one single thing, something called traction. And without it, you'll never see another dollar. If the pre-seed round was about building a car, the seed round is about proving that people actually want to drive it. This is where the story starts to fade into the background, and the data takes center stage. A seed round is typically larger, anywhere from $500,000 to $3 million. And the investors, now a mix of angel investors and formal seed stage venture capital firms, are no longer just betting on a dream. They want to see proof. They want to see traction. Traction is one of those words that gets thrown around a lot.
I spent 10 months in traction.
Or perhaps it just didn't get the traction.
But what does it actually mean? It's simply evidence that your business is working. If you're a software as a service or SaaS company, traction means monthly recurring revenue, or MRR. Even having just $5,000 to $15,000 in MRR, a small but growing base of paying customers, is a powerful signal. They'll also look at your churn rate, how many of those customers are canceling each month. Low churn means your product is valuable. If you're a consumer app, traction is all about engagement.
Yeah, that's pretty much it.
How many daily active users do you have? Are they coming back day after day, week after week? This is measured by retention cohorts. A chart showing that 40% of users who signed up in January are still using the app in March is a beautiful sight to an investor. And if you're a marketplace, like an Uber or an Airbnb, traction is about liquidity. Are there enough drivers for the riders? Are there enough listings for the travelers? They'll look at something called gross merchandise volume, or GMV, the total value of all transactions happening on your platform. This is the stage where you have to prove you've found the beginnings of product market fit. It's the magic moment when your product and your customers are in perfect harmony. The moment when users aren't just using your product, they rely on it. But hitting these early numbers is just the beginning. To get into the major leagues, to raise a multi-million-dollar Series A and cross that $10 million total funding threshold, investors stop looking for early signs of life. They start looking for something much, much harder to prove: a machine.
Welcome to the Series A.
Welcome!
This isn't just another round of funding. It's a graduation. The checks are bigger, often between $5 and $15 million. The investors are different. They are large institutional VC firms, and the expectations are monumental. At Series A, the game is no longer about potential. It's about predictability. Investors are looking for a repeatable, scalable, money-making machine. The question they ask is simple. If I give you $1 for sales and marketing, can you predictably turn it into $2, $3, or even $5 in future revenue? To prove this, you need hard, undeniable metrics. For SaaS companies, the unofficial gold standard for raising a Series A is having around $1 million in annual recurring revenue, or ARR. But more important than the number itself is its growth rate. A company at $800,000 ARR that's tripling year over year is often more attractive than a company at $1.2 million that's only growing 50%. Then they'll look at your unit economics. The most famous ratio is LTV to CAC. Customer lifetime value, LTV, is the total profit you'll make from a single customer over their entire time with you. Customer acquisition cost, CAC, is how much you spent to get that customer in the first place. A healthy business needs an LTV-CAC ratio of at least 3 to 1. For every dollar you spend to get a customer, you need to expect to get at least $3 back. Finally, they will put your entire company under a microscope in a process called due diligence. They will talk to your customers. They will inspect your legal documents. They will analyze your financial models. They are looking for any skeletons in the closet. Passing this gauntlet is how a startup truly secures its place as a major player. It's the moment it gets the fuel needed for explosive growth. Yet, even with a perfect $1 million ARR machine, thousands of startups still get rejected because the final, most crucial part of fundraising isn't found in a spreadsheet. It's played in the mind.
Beyond the metrics and the pitch decks, there are unwritten rules to the fundraising game. Secrets that separate the companies that get funded from those that get forgotten. The first is that the narrative is everything. Investors hear hundreds of pitches. The numbers start to blur together. What they remember is the story.
Why now? Why is there a massive shift happening in the world, in technology, in culture, in regulations, that makes your company's success an unstoppable force? A founder who can weave a powerful narrative around their metrics will always have an edge. They're not just selling a product, they're selling a stake in the future. The second secret is that FOMO is your greatest weapon. FOMO stands for fear of missing out. No investor wants to be the person who passed on the next Google or Airbnb. The best way to get an investor to commit is to signal that other smart investors are also interested. This is why founders try to run a hot process, talking to multiple firms at once. When one VC gets word that their competitor is about to issue a term sheet, their decision-making process magically accelerates. A maybe can turn into a yes overnight.
Yes.
And this leads to the third most important secret. You have to understand the investor's world. A venture capital firm isn't looking for a nice, stable business that will make a decent profit. Their entire business model is built on finding outliers. A typical VC fund might invest in 30 companies. They expect more than half of them to fail completely. They expect another chunk to return a small amount of money. Their entire fund's success and their reputation rides on just one or two of those companies becoming a unicorn, a company worth over $1 billion. This means they are not asking, can this business be successful? They're asking, does this business have a credible, even if slim, chance of returning our entire fund? This is why they push for massive market sizes and insane growth. They're not in the business of hitting singles and doubles. They're hunting for grand slams. And you have to convince them that you're swinging for the fences.
The journey from $0 to $10 million in funding is a metamorphosis. It's a trial by fire that forces a simple idea to become a compelling story. It pushes that story to be validated by real-world traction, and it demands that traction be refined into a predictable engine of growth. At the pre-seed stage, you sell the dream. At the seed stage, you prove the concept. And at the Series A, you scale the machine. Each step requires a different version of the founder. From storyteller to product manager to CEO, it's one of the most grueling processes in the business world. A gauntlet of rejection, scrutiny, and immense pressure. But for those who make it through, it provides the capital not just to build a company, but to earn the right to build the future. If you found this video interesting, do subscribe to the channel for future updates that may help entrepreneurs build their ventures. Thanks for watching.